And I'll just briefly go through the last chapter, which is called Doing Central Banking Better. And this chapter is kind of organized along three very simple principles. The first is we were right, which it's all oriented around when I was in grad school. What was I taught in grad school about central banking that was confirmed in 2008? And there were a couple things. One is we need a lender of last resort. The Federal Reserve's job is to be banker for the bankers. When there is a financial panic, to which finance is always and always will be prone, having the Fed step in is what stops the panic, if they do it correctly. And there's a whole chapter on 1929 and 2008. In 1929, we failed to do that. In 2008, I would argue, and I do argue, that we did it reasonably well. A central bank's political independence is crucial to its effectiveness. Now, it's interesting because when I was in grad school, I was taught that the reason central banks need to be politically insulated is because there will always be pressure from the politicians to create more inflation, because inflation operates with a lag. So in most cases, politicians who would like to win an election can tell the central bank, if it's not independent, print some more money. People think they're richer. Then I'll get elected. Then they'll realize prices have gone up and nothing's changed but the zeros on the currency. And that's pretty much been the story throughout history. 2008 was different in that there was so much political hostility to creating more money and propping up the banks. And a lot of the political resistance came from the political right, warning of hyperinflation. But the same basic thing, which is the Federal Reserve needs to be relatively unencumbered from politics so that it can do what it believes is necessary to stabilize the system and protect the currency. And throughout 2008 and since then, the value of the dollar has remained remarkably stable. A modest inflation target is better than zero. This one I describe in greater length in the book, but as we have seen even since 2008, if you aim for perfectly stable prices, the Federal Reserve can only cut interest rates to zero. We thought. We've now seen them negative in parts of the world. We can talk about that. If you have an inflation target of, say, 2%, which is what the United States now has, if interest rates go to zero, they've really gone to negative 2%. So you may not be paying any interest, but the money you're paying back on your loan is worth 2% less than it was when you borrowed it, which is effectively a negative interest rate. So there are many practical reasons for a modest and stable inflation target. The central bank should regulate the institutions for which it is the lender of last resort. So if you're the one who bails out people when there's a metaphorical fire, you should have the right to make them put in fire alarms, right? And we can talk much more about that in the Q&A period if you would like, but there is certainly a symmetry there. Now, what things we learned in 2008? There are plenty of effective tools after the Fed hits the zero bound. So once interest rates hit zero, we had QE1, QE2, QE3. There are a whole bunch of other fancy tools that can be used to push down long-term interest rates, things that were at most hypothetical crazy ideas when I was in grad school. Bank of Japan tried them first. The Fed has done, obviously, a number of them. We need to pay more attention to systemic risk. There were a fair number of people around 2005 who had a pretty good idea that the real estate market was overheated. There are very, very few people who had any sense of how that collapse in the real estate market would spread so viciously throughout the global system. So if you've seen The Big Short, that's the best illustration of how it was, those toxic assets and the bogus rating agencies attaching values to those assets. That's what happened, but nobody really saw that coming. So somebody, arguably the central bank or the central bank in conjunction with the Treasury, needs to be looking across the system and thinking, okay, if that house catches on fire, even if we know the person there is irresponsible and we don't want to bail them out, what happens to the rest of the neighborhood? And it remains to be seen whether we have successfully done that or whether we've just changed the nature of the next crisis.